Hello everyone. Good day to all of us. I hope wherever you are now, you are safe, and you are well and good. Okay, this is our first lesson for the midterm. Okay, so the title of this lesson is Internal Control and Cash. Now, in our previous discussions, we discussed about financial statements in general. And starting this chapter, we will discuss this specific account called cash. And along the way, we will also discuss some of the topics about internal control. Okay, so internal control is defined as a plan of organization and a system of procedures implemented by company management and the board of directors designed to accomplish the following five objectives. Number one is to safeguard assets. Okay, so internal control helps us safeguard our assets. No? It helps us maintain security, in our financial records, and as well as safeguarding those assets that are most prone to theft. No? Second would be encourage employees to follow company policies. This is the same with how policemen maintain peace and order. So a good internal control would encourage our employees to follow company policies. Number three is to promote operational efficiency. Okay, so since all your employees were doing good, they are doing what are they supposed to do, in turn, we are promoting operational efficiency. Operational efficiency is maximizing our assets, and um, doing or achieving our output and our goals and objectives for the least amount of cost. Ensure accurate, reliable accounting records. Of course, if the employees were doing well, and internal controls are good, in a company, would follow also, that the records are accurate, and that uh, um, all the reports, being given, by the accounting department, are uh, they are reliable, information. And lastly, comply with legal requirements. So let us discuss, a bit about fraud, and its impact. Fraud happens, when there is no internal control, or the internal control is loose, nor it's not that operational. So when we say fraud, it is the intentional misrepresentation of facts designed to persuade another party to act in a way that causes injury or damage to that party. Fraud is a huge problem and is becoming more extensive, not only in the US but across the globe. So even in Philippines. A 2016 report by the Association of Certified Fraud Examiners revealed the following statistics about fraud. So these are worthy to note. First here is a typical organization loses 5% of its revenue each year to fraud. This translates to a worldwide projected annual fraud loss of over $3.7 trillion. So just imagine that amount. That is because of fraud. And even in a company, 5% is high. Although the amount is relative, the company with higher assets, revenue, um, would in 5% is high. Even in small companies, 5% is relatively high. Next year, the median loss in occupational fraud cases is $150,000. These tend to be cases involving employee theft. So if you are working, or somebody who is working, in an office, or in a company or in a plant. Okay, so this happens, no, in offices. No, there are theft, no, employee theft. No, you cannot watch your employees 24/7. So there are times wherein employees would be able to commit theft. No, of course, if you have good internal control practices, no, this could be prevented or minimized. Next, of the reported fraud cases, 23% have caused losses of at least $1 million. These larger cases tend to involve misleading financial statements. Okay, although the reporting, no, of the financial statement is just in paper, no, but remember, no, that the information in financial statements are being used, no, by the users of financial statements. We call it the managers, no, the employees, the owners, the stockholders. No, these people use the information being provided by financial statements. And if that financial statement or that information is wrong, it could lead to um, operational inefficiency. Of course, sometimes, no, if we believe that that amount is correct, no, and we do some acts, no, relating to that knowledge, no, sometimes we will be able to make decisions that are incorrect, no, or that would not help the company. Next, no, the longer a perpetrator has worked for an organization, the higher the fraud losses tend to be. Okay, so this is very common, no? Of course, no, when an employee is or works in a company longer, of course he already knows the SOPs, no, the uh, even the internal control being in place in the company. No, he knows that, no, because he works there. No, so if the internal control in this case, no, will have some loopholes. No, you cannot really have 100% internal control. There will always be loopholes. No, that's why we are trying to improve from time to time. No, and if that employee is working or in an organization for a long period of time, that employee could have known, no, the secrets, no, of the, if there are secrets, no, to the internal control. Next, the most reported frauds, 77%, are perpetrated by employees in one of the six departments: accounting, operations, sales, executive upper management, customer service, and purchasing. Okay, so that is the top six. Now take note of that top six departments where fraud is being committed. Okay, so in a company, no, if you are the manager, no, if you're the CEO of the company, you should um, make sure, no, that these six departments, no, are well guarded with good internal controls. Next, most occupational fraudsters are one-time offenders with clean employment histories. No, so as I've said, no, these employees have clean employment histories. No, but sometimes if they are tempted, no, to do something, no, especially if they need money, no, or if they badly need an amount, no, probably one of their families got hospitalized, no, or whatsoever, no, and they were forced to do something, no, that, for example, theft, no, they could do that, no. That's why most occupational fraudsters are one-time offenders, no. Next, in most reported cases, fraudsters exhibit one or more of behavioral red flags, including, okay, take note of these red flags, behavioral red flags. First is living beyond one's means. No, this is very important. So if you see a person which is living beyond his means, no, there is this about. Oh, you cannot really point that to that person. No, it's not absolute. No, probably he is given money, no, by um, his or her relatives, no, or whatsoever, no. But generally, no, when a person is living beyond his means, there is this possibility that that person commits fraud. B is financial difficulties. No, again, no, as I discussed a while ago, if you have financial difficulties and if you are forced to do something, no, you could commit fraud. No, and lastly, unusually close associations with vendors or customers. The term here is unusually. No, it's okay to be close. No, most especially know that we promote good relationships, no, with our vendors and our customers. No, it's good to be close to them. But the term here is unusually close. No, unusual. No, it's beyond normal. No, so if that happens, that person could be committing fraud. Okay, so we have here, I would like to discuss some internal control procedures. The first here is smart hiring practices and separation of duties. Okay, an extremely important aspect of internal control is that separating the three accounting duties. No, first is asset handling, record keeping, and transaction approval. Accountants must not handle cash, and cash handlers must not have access to the accounting records. If one employee has both cash handling and accounting duties, that person can steal cash and conceal the theft. Okay, so that should be separated, no, the handling, no, and the recording, no, because if you are the one who records the transactions, and if you are also the one holding cash, you could actually get some cash there and record it as expense in the business, no. So there should be check and balance, no, that those functions should be separated. Okay, next, internal control procedures is comparisons and compliance monitoring. So no person or department should be able to completely process a transaction from beginning to end without being cross-checked by another person or department. So again, no, you cannot just entrust, no, a transaction with one person or one department. No, there should be another department who are cross-checking that person. No, actually that's synonymous, no, to the person who handles and records cash. Now, one of the most effective tools for monitoring compliance with management's policies is the use of budgets. Okay, so why do we use budgets? Because we want to check, no, our employees. No, if there is a budget, no, that is the guide for spending. No, so when we say budget, it is a quantitative financial plan that helps control a company's day-to-day management activities to keep its profit and cash flow in line with management plan. So if you have a budget, no, and probably there are deviations to the budget, that could happen, no, in normal case. No, sometimes budget is not followed, no, but that should be justifiable, no. But that is a way, no, of checking whether your transactions are legitimate or not, no? And it's one way of checking fraud. To validate their accounting records and monitor their compliance with companies' policies, most companies have an audit, no? An audit is an examination of a company's financial statements and its accounting system, including its controls. So we call this internal audit, no? So these internal auditors, no, are assigned, no, in companies to check the operations, no, the flow charts, and as well as checking the system, no, of financial reporting, no, and of course checking the amounts. Normally, internal auditors are accountants, no, because they have knowledge, no, in financial statements and operations. Okay, another internal control procedure is adequate records. So all accounting records provides the details of business transactions. Now, the general rule is that all major groups of transactions should be reported by either hard copy documents or electronic records. No examples include sales invoice, shipping records, customer remittance advices, purchase orders, vendor invoices, receiving reports, and canceled or paid checks. No, so these are what we call as evidences, no, or source documents. No, if you purchase something, that should be supported with sales invoice or official receipt. No, and that is necessary. No, that is internal control procedure. If you see a disbursement, no, you see a disbursement and then there's no sales invoice or official receipts attached, you should think, no, if there are fraud that happened in that transaction. No, that is actually a red flag. But of course, no, there are instances wherein the official receipt cannot be provided, no, by the supplier, or sales invoice is not available. No, there are cases like that, no, but that should be validated and justified. If you have a checking account, no, who among you here have checking accounts, no, you know that all the checks in your checkbook are pre-numbered, no, so the checks is numbered in series, no, 1, 2, 3, 4, 5 up to 50, no. So if one of the numbers is not in the checkbook, no, probably that check is lost, no, and that should of course pose a red flag, no, in the management, no, because a single check, no, could be especially if that is a blank check, no, that should be that can be in cash, no, by the perpetrator, no, and that is also the reason why in your transactions, no, it is you should not make pre-signed checks. So if you have checkbooks, of course, no, if you employ a good safeguard, no, in that check, that's okay. But please, no, prevent, no, or avoid pre-signing checks, no, because pre-signing checks, no, is it's very dangerous, no, because if you pre-sign a check and that check has been lost or stolen, no, the one who steal the check can put any amount that he want, no, in the check, no, because it's already signed, no, and that could be taken from your bank account. Okay, another internal control procedure, limited access. Okay, to complement the segregation of duties, a company should limit the access employees have to assets based on their job's responsibilities, no? So depending on the responsibilities of that person, give him access, no, to that specific duty that he does. No, don't give access to all. Now, for example, the access to cash should be limited to employees in the treasurer's department. And the supply of unused checks should be kept under lock and key. Okay? So that should not be accessed by anybody. The access to inventory should be limited to warehouse personnel and employees responsible for shipping and receiving functions. Also, warehouse, no, that's very important. No, that warehouse personnel should be only the one who has access to those rooms, no, because what would happen if anybody has access, no, anybody could get supplies, no, without being recorded, no. And also you can actually if that person is the one in charge, no, in the warehouse, no, and something has been stolen, no, or a supply or an equipment is lost, no, you could make that person liable, no, because he's the only one who has access to that inventory, no, or a supply. Okay, next, proper approvals. So no transaction should be processed without management's general or specific approval. No, so big companies, no, employ this. So the bigger the transaction, the more specific the approval it should have. No, so sometimes if, for example, the transaction is 50,000 or below, no, this person can approve. But if the transaction is 100,000, this higher person will approve. Or if the transaction is 500,000 and up, this specific person, specific person will approve. That's an example. Okay, so why do we associate cash with internal control? In our title, internal control and cash. So why do we associate them? The answer is because cash is the most liquid among all assets. When we say liquid, liquid is when we say liquid, that is the ability of an asset to be converted into cash. So cash is already cash. So it's the most liquid among all assets, the most prone to theft and misappropriation. So it's easy to steal cash than to steal computer. You can actually put cash in the pocket, but the computer, you cannot put that in your pocket. That's why cash is the most liquid among all assets. Okay, so when we are talking about cash, the picture gives you an idea of different currencies. In different countries, we have dollars, euros, yen, and etc. In the Philippines, we use peso. Okay, so for the purpose of discussion, we will discuss what is cash in bank, cash on hand, and petty cash fund. Okay, so when we say cash in bank, that is the cash that is being kept in the bank, or in cooperatives. Maybe some of you has cash in bank. Cash on hand, on the other hand, is cash that is in your possession. The physical money is in you. That's cash on hand. And petty cash fund, these are cash or small amount of cash which is being set up by a company in order to accommodate small expenses, which is impractical to pay through check. Because one good internal control is that all your disbursements should be made by means of check. But it's sometimes impractical. If you pay 10 pesos and you use a check. Remember that each check in your checkbook has cost. Depending on the bank. Sometimes one check will cost you 3 pesos, or 5 pesos, depending on the bank. So it's impractical to pay 20, 30, 40, 50 pesos and you use the check. So that's why petty cash fund is there to accommodate those petty expenses. Okay, so we are talking about check a while ago. So this is a sample of check. But I believe all of you have seen a check. But for the purpose of illustration, this is an example of a check owned by Green Valley Coffee Company. So Green Valley Coffee Company here is called the maker. The maker is the one who prepares the check, or he is the one who owns the money. So your check is connected to your bank account. So Green Valley Coffee Company owns an account from an account at First National Bank. So this is the bank of Green Valley Coffee Company. So First Valley Bank is also the one who issues the check, or issues the checkbook, the blank checkbook, the bank. So maker is the one filling up the check, details of the checks. So the maker will fill out the following information. We have here the payee. So the payee is the one who has the authority to encash or deposit the check. So we have here superior office product. Probably Green Valley Coffee Company purchased some supplies from superior office product, and Green Valley Coffee Company paid superior office product amounting to $320. So that is the amount. And we have here on upper right, we have here a number, check serial number. This is what I discussed a while ago, that all checks are pre-numbered. So you have here the series number of the check, no, 338. So next to 338 is 339 and so on. Okay, so we have here the date, no, of the check. No? The date of the check is very important because that is the date wherein the payee can encash the check. No? So there are checks that are called post-dated checks. Post-dated checks are checks issued, no, but the date indicated there is a future date. No? That's why we call it post-dated. No? So if you put a future date in your check, we call that post-dated check, and the date is the time that you can encash the check. No, prior to that date, no, you cannot encash the check being issued to you. So we have here the amount in words, no, $320, no, dollars, and we have here the maker authorized signatures. Now, in case of corporation, no, in case of corporation, since this is corporation, no, the corporation should authorize who are these authorized signatures, no, and register that with the bank, no, because the bank will not accept any signature, no, whatever is registered in the bank, no, as authorized signatory, that will be checked, no, when the check will be encashed. Okay, so in personal account, on the other hand, so if you, for example, you open a checking account in certain bank, no, and that is tagged personal account, the signature should be yours. No, nobody can sign that check in behalf of you. Okay. For discussion also, no, this is a cash in bank ledger. No, we all know that, no, in our basic accounting. Ledger, no, but this is a T account. No, T account is a representation of ledger. So we have here cash in bank. The left side are debits, no, and the right side are credits. No? So all transactions in the debit side of cash, these are all additions to cash in bank balance. And all transactions on the credit side of cash in bank are all deductions from cash in bank balance. And bank statement, no? Okay, by the way, bank statement class, no, is a report made by the bank, no, usually a month, no, once a month, being furnished by the bank to the depositor, which shows all the balance, all the withdrawals made, all the deposits made, and the ending balance. Okay, so it's simply a mirror of your ledger. Okay, so when we have debited 1,000 in your cash in bank ledger, so what does a debit in cash in bank account mean? That is actually an addition, no? So that's a deposit, no, to cash in bank. So all deposits, no, all debits, so should always show in your bank statement. So if you put a debit transaction in your cash in bank, that should also appear in the deposit section of your bank statement. And all credits, no, again, credits, if we are talking of cash in bank, credits are all withdrawals. Okay, these are withdrawals or deductions from the cash in bank account. So all credits should appear in your bank statement also as a deduction. Okay, so in this case, 1,000 debit, 5,000 credit, the balance should be 500 pesos. Okay, in your bank statement, there are deposits 1,000, withdrawals 500, there should be 500 balance. Okay, so again, as I've said, since ledger is a mirror of bank statement, they are called reciprocal accounts. No? So ideally, no, their balance should coincide. No? Okay, so sample of a ledger. No? This is example from records of Green Valley Coffee Company. Okay, so this is a ledger. So as you can see in the ledger, we have this the columns: date, item, debit, credit, balance. Okay, so we have here the balance on December 1, 2018. We have 6,550. Okay, so in the ledger, you will be able to see all the transactions. We have here on December 2, we have cash receipt, no? So that is added in the balance. Another cash receipt on December 7, 190. So that is added again in the balance. December 31, all cash payments, 6,150. Okay, so that is being recorded in bulk. No, probably the company is using cash disbursements journal. No, so the breakdown of this 6,150 is shown below. Okay, so 6,150 are checks number 332, 333, 334, 335, 336 with these amounts. No, 337 up to 340. Okay, and the total amount here is 6,150. Okay, so that is being reported on the credit side of the ledger. That is deducted from the balance. And lastly, on December 31, there is again cash receipt of 1,600. So the ending balance of your book, no, or general ledger is 3,340. This is an example also of a bank statement. No, actually, the format, no, of a bank statement differ from bank to bank. No, but the concept is the same, or the information that it provides are the same. So in this bank statement, no, everything has been labeled. No? So we have here beginning balance. No? As you notice, they have the same beginning balance with ledger, 6,550. We have here total deposits, 4,370. Okay, 4,370. Okay, so these 4,370 are being described, no, in deposits below. So we have 5 transactions with these amounts. So that's 4,370. Next, we have withdrawals, or total withdrawals. No, we have 5,000 pesos. Okay, so we have here the transactions. No? And we have service charges of 20. No? So, where did we get to 20? Napo din ang iyang details. Okay? And we have here the ending balance. Of course, how do we compute for ending balance? That is beginning balance plus deposits plus withdrawals minus service charges equals 5,900. So, notice, class, know that the ending balance in your bank is not the same as ending balance in your book. No? How come? No? Okay, so as we discussed a while ago, no, ledger is a mirror of your bank statement. So all transactions in the ledger should be the same with all transactions in the bank statement. No? But there are instances wherein there is a timing difference, no, of the recognition of transactions. No? Just like in this case, the resulting ending balance of ledger is 3,340, but the bank ending balance is 5,900. No? So if the bank statement does not coincide, no, with your balance in the ledger, we should prepare a bank reconciliation statement. Okay? So a bank reconciliation statement is a report which brings into reconciliation or balance the amount of, or the cash balance per bank, no, that is in the bank statement, and the cash balance per book or the ledger. Okay, so let us prepare the bank reconciliation statement in this case. Okay, so we have here the data, no, that we have discussed a while ago. So on the left side is our ledger. So as you can see, the ending balance of the ledger is 3,340. And on the right side is your bank statement. As you can see, the ending balance of cash balance per bank is 5,900. They are not equal, no? So we will prepare a bank reconciliation statement. So this is the bank reconciliation statement. So we have to write first the balances on December 31. Okay, so we have here the balance per bank. Now, this first portion here is the bank portion, and here is the book portion. So the balances per bank and per book are the following. Sa bank, it's 5,900, and sa book, it's 3,340. Where did you get that? Here. No? 3,340 and 5,900. Let's go back. Okay, so next is since the amount were not equal, no, there are actually four major bank reconciliation statements, and we will discuss them one by one. Let us go first in the bank. Okay, so there is this called item deposits in transit. Okay, when we say deposit in transit, this is amounts, no, that are or these are deposits made by the depositor, no, but are not yet reflected in the bank statement. No, so is it possible, no, that you deposit some amount in your bank and yet it does not reflect in your bank statement? Yes, it's possible. No, most especially if you are depositing on at the month end, no, because the bank, no, most especially if you are depositing after the cut-off time, no, some banks are implementing cut-off time wherein if you will be able to deposit these amounts after the cut-off, those deposits will be recorded in your account on the next banking day. Okay, so what will happen if you deposit on a Friday, which is the last day of the month after cut-off? Of course, that will be reflected on your bank statement on Monday, no, which is the next banking day, and that is next month. No, that is another month. So when the bank will furnish you a bank reconciliation statement, it will not reflect on your account. Okay, so in this example, deposit in transit is 1,600. So where did we get 1,600? Let's go back. Okay, so again, as I've said, deposit in transit are deposits made by the depositor, but the deposit is not yet reflected in the bank statement. So where are our deposits here? So if we look at the ledger, no, as I've said a while ago, the debit side, no, of your ledger are all deposits. So we have here 1,150, 190, and 1,600. Okay, if you look all the deposits in the bank, okay, the 1,150 is reflected in the bank here as deposit. 190 is also reflected in the bank here. Okay, 12,8. But the 1,600, or that deposit was made on December 31. 1,600 is not reflected in the bank. You cannot see it in the bank. No. So the reason, no, as what I discussed a while ago, December 31 is a holiday. No, I just wonder why the deposit was made on December 31. No, but there are banks that are open on holiday. No, but all the transactions will be reflected on the next banking day. So we have here 1,600. It will be reflected in the bank statement on January of the next year. So it's not reflected in the bank statement on December. So that's why it is called deposit in transit. No, it will come. No, it will be reflected in the bank statement. But there are, as I've said, there are timing difference. Okay, so let's go back to bank reconciliation. So the deposit in transit is 1,600. You add that, no, on the bank balance, no, because that is already deposited, but it's not yet shown in the bank statement. Next is outstanding checks. When we say outstanding checks, these are checks that are being issued, no, by the depositor, no, to the suppliers, no, or to whoever he wants to pay the money, but it's not yet reflected or deducted in the bank balance. Okay, remember class, no, that every time you issue check, no, to a certain person or payee, and that person encashes the check at the bank, no, the amount will be deducted from your account balance. Now, there are various reasons wherein these outstanding checks occur. one classic reason is that there is this clearing difference, no, or clearing time, no, from the time you encash your check up to the time that um, you will or shall I say deposit, no, from the time that you deposit the check up to the time that you will receive the amount in your bank, no. So there is the timing, there is a clearing, no, clearing time. um, Previously, no, previous years, no, the clearing time is 3 days, but with the technology that we have now, no, the clearing has been shortened to 1 day. Okay, so that is one primary reason. Another reason is that probably the payee did not just really encash the check, no, for whatever reason. No? For example, I paid a check, no, to my friend, no, and my friend just keep the check in his book, no, as bookmark. No, so I have given the check to him, no, but he just put it in the bookmark, in the book as bookmark, or he just put it in the drawer or wherever he wants, no, and he did not encash that in the bank. Of course, the amount will not be deducted from my bank balance. If he lost the check, no, that check anymore will not be encashed in the bank, and that will not be deducted from my book, from my bank balance. No, of course, no, me as depositor or issuer of the check will know because I have records, no, of what are the checks that I have issued. No, so let us look at the outstanding checks. No, let us look for outstanding checks. Okay, so let us look at the checks being issued, no, by the depositor. So in this case, the check series number is from 332 up to 340. Okay, that is 9 checks, no, with the amounts 3,510, no, and so on. A total of 6,150. Let us look if these checks are presented in the bank or reflected in the bank. Okay, let us look at the checks portion. So we have here check number 307, 332, 333, 334, 335, and 336. Okay, there is this obvious error here, no? Because we don't have check number 307, no? But the bank put 307 here. So this is an obvious bank error. No? The bank also commits error, although this is seldom, no, but they could also commit error because the tellers are just humans. No? So 307, no, this is an error made by the bank. So in our reconciliation, we should add that back, no, because the effect of checks, no, in this section is a deduction from your bank balance. So since this 100 pesos has been deducted from your bank balance erroneously, so you should put that in your bank reconciliation statement as a deduction. Okay, so we have here bank error being added 100. Okay, again, let's go back, no, to the problem. Okay, so again, let's go back from series number 332 up to 340. Let us look at the checks, no, in the bank. Number 332, 3,000. Number 333, 150. Number 334, 100. Number 335, 100. Number 336, 1,100. Okay, so we have seen here an error, although you can really see that, no, because it is being tagged here, no, as asterisk. It is being stated here that the correct amount of check is 150. So who commits the error here? It's now the book, no? Okay, so in real case scenario, no, this will not be written, no? You are the one who will look for the error. So, for example, if you see check 333 as 510 and in the bank it's 150, you should If you are not sure who commits the error, you should look at the source document or the check itself. Okay, the bank can show that to you. So in this case, the correct amount is 150 because it's being tagged here as 150. So this is an example of book error. We will come back to that later, no? Because that is an error of the book and not the bank. We will go back to that later. No? But we will focus here on finding the outstanding checks. So the checks being cleared in the bank here is 332, 333, 334, 335, and 336. Okay? If you notice, you cannot see here 337, 338, 339, and 340. Okay, the last 4 checks here is not reflected in the bank statement, which means that these 4 checks are called outstanding checks. Okay, so we have here the amount 280, 320, 250, and 490. Let's go back to our bank reconciliation statement. So we will deduct outstanding checks because that is not yet deducted in your bank, but in your book it is already deducted. So check 337, 280, check 338, 320, check number 339, 240, check number 340, 490, and we have here the adjusted cash balance. Sorry, that is adjusted cash balance. No, that is the portion there being covered no by my video. Adjusted cash balance 6,260. Okay, so that is the correct cash balance. No, so we will move to the computation of the book balance. No, and ideally they should be equal no with the adjusted cash balance per bank. Okay, so let's go back. Now our cash balance per book is 3,340. Let's go back to the data. Now, by the way, no, the first item that we are going to look for here are first is the credit memos. No, credit memos is a book reconciling item. No, these are receipts of cash. No, being reflected in the bank statement, but it's not yet reflected in the book. Okay, so it's the opposite of deposits in transit. No, so the credit memo, the amount is already reflected in the bank, no, but it's not yet reflected in your book. So how does it happen? No, that there are some amounts being deposited in your bank or being credited in your bank account, and you do not know or you are not able to record it. Okay. So let us look at the data no, of what are these credit memos. Okay, so these credit memos are, as I've said, these are deposits or cash receipts not representing deposits. No, it is being credited in your bank, but it's not a deposit. So in this case, no, let us look at the deposits being or credits being recorded by the bank. So we have here actually 5 deposits. No? 5 deposits, but the deposits made by the depositor or initiated by the depositor is only the first 2 deposits, which is 1,150 and 190. Okay? So, mo lang na siya. No, that is the amount being initiated no, by the depositor. No, and the next 3 no, deposits, we have EFT. EFT is what we the meaning of EFT is electronic fund transfer, receipt of cash dividend. Okay, probably there is this tax being held no, by Green Valley Company, no, and it's being linked in its bank account. So that's why the dividends declared are automatically reflected in the bank account. Okay, so it's not that Green Valley does not know. No? Probably, Green Valley knows that there are some amounts that will reflect in his bank, but he does not know it yet, know how much, no, or it's not being confirmed, no, or as long as he did not receive the bank statement, he will not know, no, that the amount is already credited in the bank. No, another credit memo here is bank collection. Okay, so bank collection happens when your customer pays you directly to the bank. Okay, so most especially if the payer no, or your customer is more near, no, in the bank than on your store. So sometimes the customer would just opt to pay through the bank and deposit it directly to your bank account. So that is bank collection 2,100. And lastly here, interest. Okay, classic example is interest. If you have some savings account there, or interest bearing account in the bank, you will notice that every month or every quarter, depending on the bank, or every year, no, an interest amount will be credited to your bank account. Okay, so that is classic example. So it's not, as I've said, it's not that you do not know, no, that there is an amount. You just don't know how much is the amount. No, of course, you expect, no, that interest will be credited if that is monthly. You expect that monthly interest will come to your account, but you just don't know how much. So you just wait for the bank statement to come and then record it as income. Okay, so since these amounts here are reflected in your bank statement as deposits, but it's not in your book. So this is a book reconciling item called credit memo. So we have 3 credit memo, 900, 2,100, and 30. Okay, let's go back. Okay, credit memo, 900, 2,100, and 30. Those are all added to your book balance because the correct recognition should be made in your book. No? Because the bank's reporting is correct. No? So it should be reflected in your book. So those are credit memos. Okay, again, let's go back to the error that we have made a while ago. So the error that we have made a while ago is that check number 333, no, it's the error of the depositor, no, because the depositor record check number 333 as 510. But if you look at the bank, it's only $150. Okay, so the difference here, no, is 360 pesos. No, the difference is 360 pesos, and that should be added into your book because the result of this class, no, the result of this check, this has been deducted in your bank, in your ledger. No, this has been deducted, so you should add that back, no, the difference of 360 in your book. So let's go back to our bank reconciliation statement. That should be added, no, overstated our check number 333. So that is added in the book for portion of your bank reconciliation statement. Lastly, we have debit memos. Okay, so debit memos are withdrawals. No, I cannot say it's withdrawal, but it's a deduction from your bank account. No, and the bank already recorded it, no, in your bank statement, but it's not yet recorded in your books. So let us have this example of debit memos. So again, debit memos is the opposite of outstanding checks. No, because when we say outstanding checks, these are recorded in the book but not yet in the bank. When we say debit memos, these are recorded in the bank but not in your books. Let's go back. Okay, what are these debit memos? Let's find the debit memos. These are deductions from your bank account that is not in your books. So in your books, as you can see, all deductions are checks. No? Check number 332, 340. Let's see if there are deductions in your bank statement that are not checks. Okay, as you can see here, there are deductions here, no? Other deductions. These are actually deducted from your bank. We have NSF check, 50 pesos, $50 rather. NSF check. So NSF check, these are not sufficient fund checks, meaning these are checks you collected this from your customer and you deposited in your bank, but later on, no, the bank returns the check because there are no sufficient fund in the account of your customer probably. Okay, so NSF check, so that will be deducted from your bank balance, no? Because originally it was deposited and added to your book, in your bank balance. So NSF check 50 and insurance. So that is also deducted from your bank. And lastly, we have here service charge. Okay, service charge is also deducted from your bank. And all these three are not reflected in your books. So service charge 20, NSF check 50, and insurance of 400. These three are called debit memos. These are reflected in the bank statement as deductions, but not in your ledger or books. Okay, so let's go back to bank reconciliation statement. So we will deduct here the debit memo, service charge, NSF check, and insurance expense of 400. Okay, the adjusted cash balance is 6,260. Okay, in all cases, class, the adjusted cash balance of bank and the book should be the same. So after you prepare this bank reconciliation, you have proven that your bank and your book has the same amount. Only that there are just timing differences in the recognition of items. Okay? So when you report in your financial statements, the adjusted cash balance should be reflected because that is the correct balance. Okay, so this is the end of my presentation. Thank you very much for listening. Take care always, stay safe, and God bless us all.